Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So I'm fresh back from a long weekend where I got a little bit too much sun, as you can probably tell. But this video, we're going to be working through a Q&A. So I put up a community post all about doing this Q&A video, collected all your questions, and we've got quite a few questions to get through. So I think I'll get straight into it. If you do want to have your question answered in future Q&A videos, definitely turn all your notifications on for the channel, and that way you'll be notified every time that I post on that community page, and you'll be able to get in quick with asking any questions for the next one. So with all that said, let's get straight into it, and I hope you enjoy. If you do, definitely hit like. Let's get into it. Okay, so first question we have is from Karan. Apologies in advance if I butcher any names, because I am almost guaranteed to do that. But Karan's question is, any new stocks on your radar after Sharesight? Yeah, so probably the company I'm doing the most digging on at the moment is just kind of refreshing myself on the A2 Milk Company here in New Zealand, actually. So the A2 Milk Company is a business that I did a video on over a year ago, probably close to 18 months ago on the channel. That's still up if you want to go check that out. And I'm just kind of refreshing myself on that business. So they've had a couple of changes in management since I filmed that video only a year or so ago. The business has grown quite a bit. I think earnings was up something like 50% in the last year, and the stock is only up about 8 or 10%. So looks kind of interesting. I'm doing some digging on that at the moment. I actually filmed a video on A2 Milk towards the end of last week that I was going to put out on the Saturday just gone, but I just wasn't happy with how it turned out. So I may refilm that one once I have, finished all my research on A2 Milk. So that is probably at the top of the list at the moment. Okay, second question is from Angus Mackay. If you change your mind on a company from an ethical standpoint, would you sell it straight away or wait until it has appreciated to a fair value to sell? So this is a position I've never actually been in, to be honest. I have never invested in a company where I felt like I was sort of ethically compromised or anything like that. So in a lot of ways, I think it's kind of personal preference. I know if you follow kind of the Phil Town or Danielle Town methodology, you're constantly investing with your values. And if something changes there, you probably are going to sell it straight away. If you follow more of the Warren Buffett approach, you sort of say that, he'll invest in just about anything if it's a public stock that he doesn't intend to, own the entire business for forever, basically. If he's just investing in a public stock, he will probably invest in just about anything if it looks attractive financially. So, tobacco companies and things included. Whereas if he were to purchase entire ownership of that business and buy it out, take it private, or buy an existing private business, then it probably would have to align with his values, because it's kind of under the hood of Berkshire and he has to own it forever. So that's kind of more the standpoint I take. I must say I've never been in that position, so I don't know yet. But if I was to look at buying a private business at some point, it would definitely have to fit my values. If it was a public stock that looked really, really attractive, I would potentially still make the investment anyway, even if it wasn't one of these, really top-rated, super ethical companies or anything like that. So that's kind of where I stand. But yeah, certainly personal preference, and I understand completely people that don't want to invest in, the tobacco companies of the world and that sort of thing. So that is that one. Okay, next question is from Michael Slade. How do you go about finding companies that are value plays? Do you actively look for companies that look cheap and then research them? Or do you have a selection of companies that you've researched and want to invest in and buy them when the price drops to a certain level below intrinsic value? So I would say both. So I have sort of an existing watch list of 10, 15, 20 companies, somewhere in that range, of basically really, really high quality businesses like the Apples, the Facebooks, the Costcos, the Monster Beverages of the world, a whole bunch of businesses that have had really good growth over a long period of time, have great competitive advantages, have good management, but for the most part, they're really expensive. So those sort of sit on my watch list, and if they ever do get to a point where the price makes sense to me and I have a large margin of safety and all that sort of stuff that I talk about all the time, that's when I'll make the investment. So I definitely have a list of those companies. The other thing where I've probably found more investments in recent times is to look at companies that on the surface of things look really cheap and try and figure out what's going on there. So, looking at the Seritage growth properties of the world that are possibly trading below liquidation value. You know, a year or two ago, looking at the GraphTechs of the world, where we thought that their earnings over the next 3 years were going to equal the entire market cap of the company. So there's a few businesses that are probably lower quality that I just would look at because they look really cheap, or maybe some other investor has bought them. And then there's other companies that are just super high quality, have been really high quality for a long period of time, but the price is high and they just sort of sit on a watch list. So I do a bit of both to answer your question. Dandy Finance, which guru investor has had the most impact on your own investing strategies? Which one are you following the most? That's hard to say. So I would say at a high level, you know, overall investment strategy, probably someone like Warren Buffett and Phil Town have been the two biggest influences. But in terms of the person that I follow the closely, that's probably someone like Monish Pabrai or maybe Guy Spear. So there's a whole bunch of people in the mix there. In terms of learning investment strategy, Warren Buffett and Phil Town are definitely the big two there. Monish Pabrai to a certain extent as well. But as far as sort of gurus that I follow and track their portfolios, there's a whole bunch in the mix there, and I do, you know, a series on the channel all about that. So there's a few in the mix there, but those are probably some investors that are pretty high on the list. Next question is from Investing with Frank. What's your thoughts on Monish Pabrai's recent change in strategy? He seems to be looking for compounders he never has to sell, e.g. growth at a reasonable price. Do you think he's moving away from the 50 cent dollars approach he has always discussed? So, yeah, if you don't know what Frank's referring to here, definitely check out the latest Monish Pabrai talk with his annual lecture at, I believe it's Boston College. Yeah, so I watched that. I was kind of surprised to hear Monish say that a little bit. He's touched on it a little bit in the past, but to hear him say he's not looking for the 50 cent dollars anymore was kind of surprising. I think in a lot of ways he still is looking for the 50 cent dollars. So, in the past, he was looking for a business that was worth sort of $1 of intrinsic value, wasn't really growing, maybe it is a lower quality business. He was trying to buy it at 50 cents or less and then sell it when it reached about 90 cents. I think what he's saying now is he's looking for something that's worth $1, but over time is going to be worth more than $1. It's going to grow to $1.20, $1.50, $2, $3, $4 kind of thing over a long period of time. And he's still looking to buy it substantially less than that. So you could still certainly make the argument he's buying a 50 cent dollar, but he's looking to get that tailwind of growth. So this is sort of the transition that Warren Buffett made over a period of time, especially with some influence from Charlie Munger, to where he's still looking to buy businesses at a discount, but he's looking for companies where he can make really one decision, just buy it at a certain price, track it over a period of time, and just hold on to it and make good returns that way, rather than trying to have to churn part of the portfolio every time that you want to make a new investment, or every time that a stock goes up and meets intrinsic value, because you're not going to get extra growth after that point. So it's interesting, and I think it's a kind of a natural transition that a lot of these guys tend to make. I still think you'll see a lot of beaten down companies in Pabrai's portfolio in future, but it would be good to see some more compounders in there as well. So those are my thoughts. Next question from Henry. Hey Tom, value investors tend to only invest in companies within their circle of competence. What are your thoughts on finding a great company whose metrics appear excellent? Do you, 1, investigate further, or 2, dismiss and move on? Cheers, mate. Yeah, I think if you're following a group of investors and you see something new turn up in their portfolio, particularly if they've invested in it in a big way, it's a big chunk of their portfolio, it's certainly worth a closer look. It's hard to, if you've never heard of a company, you probably don't know if it's in your circle of competence until you look at it. So definitely worth a look. Some businesses are really just super easy to understand, in my opinion. So, a company that's been on my watch list forever is Monster Beverage. Very straightforward business to understand. I'm sure you've all heard of Monster. Do a bit of digging and you'll find out that they own other brands. You'll also find out that they have partnerships with Coca-Cola and so on, and you can start to understand how the business actually makes money. So I think it's definitely worth investigating further. I think I am not the type of person that would just buy a company on, statistical measures of valuation if it just looked really cheap but I didn't understand what the company does. Certainly a lot of quantitative investors do that. That someone like Tobias Carlyle would do that with his acquirers multiple and, you know, the acquirers fund. But for me, definitely investigate further. Then you can decide whether you have to throw it out because you don't understand it or whether you can keep digging on that company. Next question is from NKO Weapon. Butchered that one. When did you start investing and what was the very first stock you bought? I think I started investing probably 3.5 years ago, something like that. How about I put up the screenshots of my first ever trade? I'll see if I can track those down. I'm pretty sure the first companies I've ever bought were Freightways here in New Zealand and Fonterra, I think, here in New Zealand. So I actually made money on both of those companies, but they were very dumb kind of, just look at the chart and see that it's going up over a period of time. In the case of Freightways, and with Fonterra, it was a company I understood, but really didn't look at valuation, couldn't even tell you who the CEO was. I probably still can't tell you who the CEO is of Freightways, but I am familiar with Fonterra. So yeah, I'll put up some screenshots here. I think they were both about $1,000 investments. At the time, ASB was charging a $30 fee from memory, so they're probably $970 roughly worth of shares and plus a $30 fee. But those were my first trades. Luckily made money on both of them, but it was pure luck. So those were my first stocks. Trading Melon, go through why value investing based on DCF modeling is the only real investment style. Yeah, okay. So there's plenty of different investment styles, but it's the one that certainly fits my personality the most and makes the most sense to me. All businesses are worth the present value of their future cash flows discounted at an appropriate rate. So if a business is going to earn money next year and the year after and the year after and the year after, those nearer term cash flows are more attractive than the cash flows further out, and that's what a discounted cash flow kind of accounts for. And that's the value of a business. The job of the investor is to find out, to try and estimate what those cash flows are going to be. So for some companies that you don't understand, or that are maybe growing really fast, or maybe they're declining at some sort of rate, it might be really, really hard to figure out what those long-term cash flows are, and in that case, you just have to chuck them out. But if you can find a business where the present value of those future cash flows are, say, $1 billion, and the company is trading substantially cheaper than $1 billion, then you might have something really, really attractive on your hands in terms of an investment case. So it just makes a lot of sense to me. That is the value of a business, is the present value of its future cash flows. If you can get a good handle on what that present value likely is, then you can start to see, which businesses look attractive in terms of the valuation and which ones look expensive. You can get a margin of safety, add some protection, increase your returns, all that sort of thing. So that is why it makes a whole lot of sense to me. Okay, Businessman92, you've asked a lot of questions, so I'm just going to answer a couple of them. Just because of time, I want to try and get through as many questions as I can here. So what did I study at uni? I studied a Bachelor of Agricultural Science. I still work in that industry for an ag software business at the moment. What percent is your cash position is the other one. I'll just to pick a random one, the other question that I'll answer. What percentage is your cash position? So my cash position is actually pretty high at the moment. There's a couple of reasons for that. So the first one is I am actually looking to buy a house probably sometime within the next year, I would say. It'll depend on, finding a good deal and all that sort of stuff. So I've got basically enough cash set aside just purely for that at the moment. So that is basically a big percentage of the portfolio if you want to include that. If you don't include that cash, probably 15%, something like that, ballpark. So yeah, that's sort of where I'm at. Josh Morgan, I've read several books on value investing, watched YouTube videos, and messed around with stock screeners. What next? Do I just start researching stocks properly and buy, or is there some more I should do in preparation? So I think firstly you should be constantly learning, so continue doing your reading, continue watching stuff on YouTube of people that you think make sense, and don't ever stop doing that. You got to continue learning. But at the end of the day, there's only so much time you can spend learning about investing and reading about investing before you actually just get in and do it. I think you learn a lot from actually investing in companies yourself, putting real money to work and watching, your investments go up or down or sideways and seeing the things that kind of influence that movement. So I think at some point you've just got to jump in, but yeah, definitely never stop learning. Shane Logan, what makes Micron a potential long-term compounder? I got no idea. I've looked at Micron once. I think I did a video on it probably over a year ago as well. And at the time, I just couldn't get my head around it. It is miles outside my circle of competence. So as much as I would like to be able to understand it, because a lot of investors that I follow are in there, it's just not one I can get my head around. So that is that one. RC, hey mate, how are things going in NZ? Things are going pretty well here in New Zealand. Relative to many other places in the world at this stage. How did you work out the margin of safety rate for IRR? Yeah, so from memory, I think I was actually using my discounted cash flow spreadsheet that I've made a couple of videos on, and I was basically just putting in the same numbers as I put into the IRR and just doing a bit of trial and error to try and get those percentages basically. So figuring out, if something was at a 50% discount to intrinsic value in my DCF spreadsheet, then putting those same, numbers into the internal rate of return and figuring out what internal rate of return I would need to get that margin of safety and so on. So that's kind of the way that I worked through that. Carol A, somewhat of a different question than usual. Do you have beneficiaries set up on your investment accounts? If so, how do you decide how much to leave for each beneficiaries organizations? Are there recommended percentages somewhere? It's not something I've set up, but it's something I need to set up. My portfolio is, getting to a reasonable amount of money. So I need to definitely figure out a plan with that should something ever happen to me, I suppose. So it's not something I've formally done. I frankly don't know much about setting that up at all, but it would certainly make an interesting video topic, I think. So if I ever do go down that track, which I need to do, I'll make a video on it. How about that? So that's your question there, Carol. The Ford tragic experience, thoughts on ETFs in the USA on the Sharesies platform? Sure. So I think to answer your question, it always pays to do some digging on what's kind of underneath the hood of each ETF you're looking at investing in. With the USA specific ones, I am familiar with SmartShares US 500 ETF. So if you go onto the SmartShares website and just look at the top holdings, what you'll find is that some of those ETFs offered by SmartShares simply just own another ETF. So you've got kind of like a couple of layers of ETFs going on here. I think with the US 500, I'll put it up on the screen here, but I'm pretty sure they own a Vanguard S&P 500 ETF. So you've kind of suddenly got a couple of layers of ETFs going on here. So firstly, you're paying fees to buy the SmartShares ETF, and then within that, there are going to be fees for Vanguard. So potentially it makes a bit more sense to just put your money into US dollars through a US broker and buy it directly. It really depends on the ETF and how it's been structured underneath. But the key thing I would be looking for is really trying to minimize those fees. So anytime you see a couple of potential layers of fees, like with that one, it would be worth doing some digging on trying to figure out a way to minimize that. But yeah, I mean, if you're buying them through Sharesies, it's certainly an easy way to get exposure to that market. But you've got to be careful that you're not giving away too much of your return by just investing in the place that it's simple, but where you've got a couple of layers of fees and things going on. So that is that one. And the final question, difference between clouds and data center on modern investing. How to choose a good business in these areas and analyze which company, ticker, SWCH, or a company alike. Thanks for this channel. Thanks for your question, David. So I'm not familiar with the company Switch, so I can't give you too much on that. And there was one other question here on a specific stock that I just wasn't familiar with, so I did skip that question. Apologies if you asked that. But yeah, I think you should analyze these businesses just like you do any other business. I think with a lot of sort of software as a service type companies, you're going to find really attractive economics. So you're going to find very scalable businesses that can potentially have very high profit margins over a long period of time. So if you can get those businesses at an attractive price, it potentially makes a lot of sense from an investing perspective. So those are some of the things I'd look at. Again, try and understand the business, What's their competitive advantage? Remember that capitalism is brutal, and if someone sees a company making a whole lot of money really easily, it's very likely that competitors will come in to try and erode that competitive advantage and try to get a share of the pie. So try to understand the competitive landscape, look at who's running the business, and look at the price, and that's kind of the process I go through for every company, regardless of what it is. So those are all the questions for today's video. I do hope you enjoyed. If you did, please hit like and hit subscribe, and I will see you in the next one. Cheers.